back to our advanced series. Now, we all see the market's ups and downs, right? But here's the thing. It's not just random chaos. There's actually a fundamental pattern at play, kind of like a rhythm of expansion and contraction. So today, we're going to dig into why the market moves in these cycles and not just in a straight line.
So why doesn't it move in a straight line? Well, the key really is to look past all that daily noise, the day-to-day fluctuations. Beneath it all, the market has this natural rhythm. It's a repeating cycle, expansion, then contraction. And it's all driven by some pretty powerful economic forces, and honestly, big shifts in investor psychology.
Okay, so here's our game plan. First, we'll touch on the market's wavy path. Then we'll really get into what a bull phase is, and then what a bear phase is. And finally, we'll put it all together to see the complete market cycle.
All right, let's jump right into our first section, the market's wavy path. The first thing we need to get straight is a fundamental principle here. Yeah, if you look at a chart over a very long time, the trend has been upward. But, and this is a big but, its journey is anything but a smooth, straight line. You can almost think of it like the market is breathing. It expands for a while and then it contracts. Now, this up and down movement, this cyclical nature, it's not a bug, it's a feature. It's just a fundamental characteristic of how markets work. And it really just mirrors the natural ebb and flow of the economy as a whole.
So let's break down the first part of that breathing pattern, the expansion phase. This is the one everyone gets excited about. We're talking, of course, about a bull market. This is that period of sustained upward momentum.
And a bull market is really more than just watching stock prices go up. It's actually a sign of a healthy, thriving economy. You see, when companies are making more money and the economy is growing, people, consumers, they feel more confident. And what happens when people are confident? They spend more. This creates this really powerful positive feedback loop that just keeps fueling more growth. So visually, it looks something like this. A long, sustained upward trend. And the key word here is sustained. We're not talking about a good day or a good week. We're talking about a prolonged period where the whole market is generally moving up. And that's reflecting that strong economy we just talked about. But, as we all know, good times don't last forever, right? That expansion phase can't go on forever. So the cycle, well, it inevitably moves into its next phase, the contraction. And this is what we call a bear market.
A bear market is pretty much the exact opposite of a bull market. The economy starts to slow down, and so consumers get a little more nervous, a little more cautious with their spending. This means companies start making less money, which can drag down the whole country's GDP. It can create this kind of downward spiral in how everyone feels about the market.
And here's what that looks like. It's a sustained downward trending line. Again, just like the bull market, we're not talking about a single bad day. This is a sustained, widespread drop in prices over a long time, and it's a reflection of that cooling economy. Okay, so we've looked at the bull and the bear separately. Now for the fun part. Let's put it all together and see how these two phases connect to form one complete cycle. Because they aren't just random events, they're really two sides of the very same coin. So let's start with step 1. The cycle kicks off with that period of growth and expansion, the bull run. Everyone's feeling optimistic, and the market is trending up for a good long while. Then comes step 2. That expansion eventually hits a peak, and it's followed by the contraction phase, the bear market. The economic winds change, and the market enters that period of sustained decline we talked about. And here in step 3, you can see how it all comes together. After the bear market hits its low point or its bottom, the stage is set for a new bull market to begin. And the cycle starts all over again. This continuous wave, this is that natural, repeating rhythm of the market. This is a great way to look at it side by side. It really boils down to the feeling or the sentiment behind each phase. A bull market is all about optimism and growth, which leads to more consumer spending. But a bear market? That's driven by caution, a slowdown, and people spending less. You could almost say it's a cycle of confidence versus fear. So what are the big things to remember here? First, these market cycles are completely normal. They're just part of how the market behaves. Second, they're made up of these two main phases, the bull for expansion and the bear for contraction. And maybe most importantly, neither phase lasts forever. They are always part of a continuous, repeating pattern. And just a quick note, if you're following along with the advanced section of this series, you can go ahead and subscribe to NeuralTarot. So all of this leaves us with a pretty big question, doesn't it? We get the what, now we understand the pattern of bulls and bears, but what about the why? Like, what are the actual economic triggers that cause the market to shift from growth to contraction and then back again? Well, that's exactly what we're going to tackle in the next explainer. We'll dive into the key economic indicators that can influence and signal these major market cycles.